Hello, everyone, and welcome back to Sudden Wealth. I do hope you're having a wonderful day. If you do enjoy the content, please consider dropping that a like and subscribe. So, to begin with, quick house cleaning here. Tomorrow, I have planned another live stream. We'll be discussing broadly about the usual topics that we always do. Preparation for inflation numbers coming next week, the progress on the cycle so far, on the crypto cycle, a bit of an update also on the overall market and next macro trends. And of course, I'll be here to answer some of your questions as well. And today, I would like to start by discussing what's happening in the broader markets. So crypto market will be for the next video, but the broader market, you see pretty much all the indices facing some pressure. Typically, Russell 2000, that's why I didn't include it in my prediction for new all-time highs, or I gave it a 50-50. It's because if interest rates move higher, bonds go lower. That means more fear around regional banks, which means Russell will always be, to some extent, negatively impacted by the movement on the interest rates more than the other indices. Now, TLT continues to fall quite abruptly, which is the bond ETF that is mostly filled up with 10 and 30-year bonds. And now you see the yields raising to the highest levels since 2007, right before the 2008 financial crisis. Now, there's something which is important to look at and to go back a little bit in time to understand the bigger picture. Oh, by the way, important one. So the gold market and the trend that I was expecting for it, although I was wrong on the exact month, I was actually right on the trajectory. Peter Schiff is, of course, completely lost. He doesn't understand why gold is down, but that is typical life. And you may recall that I've been mentioning that according to my cycles, oil should peak late September, first half of October, and so far it seems that we've done that. Now, oil is a bit more difficult to call because you can have, an event like the start of a new conflict, OPEC coming out and announcing further production cuts, and all of a sudden the cycle analysis goes a bit out the window. But what I would like to see here, and according to my cycles, sometime around late September to late October, we should see the peak in oil. When I say peak, by the way, just to be clear, I'm not saying that oil will never rise again. What I'm saying is that we will put in a top, at least for a few months, but it can be longer than that. And it will be important, of course, to influence the inflation readings, because the lower oil goes, the lower the energy costs. So the lower the inflation to be expected. Now, when it comes to the bond market, and the reason why I talk about it so much is because that market influences everything else on the rest of the market. And what's happening is actually very simple. Left untouched, let's say, without the Fed's direct intervention, the bonds will always have the tendency to be worth less and less. And the reason for it is actually quite simple. Let's say the Fed stops, and like they stop buying bonds altogether. Well, but because the US is under major trade deficits and budget deficits, they need to borrow money. So if the Fed does nothing, the US government needs to borrow money, And because more debt is in the system, interest rates need to rise because, in theory, since the US has more debt, it's now less likely that they're going to pay it back. So what I'm trying to say is, what we've been seeing in the past years is the Fed basically ensuring that the bond market is artificially high, so yields are artificially low, so the stock market, the real estate market, the commodities market, etc., can do better than it actually should, and they know very well what they're doing. Okay, so what is the price you pay for doing that? So that is the question. Okay, so the Fed has done that over the last 13 years. What is the cost that we bear? The cost you bear is that new generations can barely afford a house. Stocks are extremely expensive to buy. The opportunity to actually invest and get higher returns so you can retire becomes more and more difficult. And what's happening as well is you're creating too many inefficiencies in the economy. So that's why the QE programs of the Fed are bigger. So every time that they need to do it, it needs to be bigger and bigger, because essentially the weight of the dead rock, let's say, imagine the Fed is pushing a rock up a hill, that rock is increasingly bigger and the slope is increasingly steeper. Now, what they've made a mistake was, let's print money and give it to people and tell them to stay at home. You see, because when they do QE, normally, you don't see inflation in the sense that the type of inflation that people don't like, meaning the consumer price inflation. You do see the asset price inflation, stocks, real estate, etc., but you don't see it in the supermarket. But because they gave money directly to people's hands and they told them to stay at home, so production goes lower, then inflation starts to pop up. Furthermore, shipping costs went through the roof. Why? Because when economy stopped, then when they reopened it, everybody needed ships, and everybody needed transport, and everybody needed goods to come from China, etc. So there's a big competition for transportation of goods and services across the globe. So the shipping costs go higher, so also the consumer price inflation goes higher. But what I'm trying to say is that, in theory, there is no bottom for the bond market, which, in theory, there is no bottom for the real estate or the stock market. You see, we live in a great Ponzi scheme. If the US does not get new buyers of debt, they default on existing debtors. In other words, if they don't find new investors, they cannot pay the old investors. And that's why they need to raise the debt ceiling, for example. Because they told everybody, if we don't raise the debt ceiling, we default. What does that mean? If we don't get new investors, we will default on the existing ones. And the problem is that the US has issued so much debt that the world can no longer absorb it, and I would add, doesn't even have the interest in absorbing it. So who needs to absorb it? The Federal Reserve. That's why their balance sheet went from 800 billion in 2007, and it's now, 9 trillion or 8 trillion, something like that. So basically 10 times bigger than it used to be. What I'm trying to say is that unless the US government changes policies completely, unless they help drive the economy to the point where the US starts to export more than it imports, then if the Fed does not intervene, interest rates will go higher because the Treasury needs to issue new debt to finance all of these deficits. which means as interest rates go higher, real estate and stocks get pushed down, bonds get pushed down, gold, precious metals gets pushed down, etc., etc. Now, crypto has proved to be more resilient because we are approaching, of course, the Bitcoin halving, and to a certain extent, not in the beginning. So if there's a big collapse in the debt market, crypto will also go down very aggressively because people will need to sell whatever they can. However, in the future, it can appear as a solution, as an alternative to the existing money system. Stocks, if you will, is also a bit next person buying. You want to buy a stock so then you can sell it for a higher price. Of course, there are dividends involved, but we all know that the great majority of trading is with that objective. So it's always about the next guy, the next investor. So to some extent, all of these work as Ponzi schemes, but in my opinion, I try to be in the one that has the potential to make me the most money. But in any case, what you're seeing is exactly what I've been talking about. As long as the bond market is suffering, the other markets suffer as well. And here you go. Exactly as I mentioned. Unfortunately, I'm not one of these YouTube experts, so I don't charge you anything for that kind of information, because I don't need to grift my audience to survive. So thank you very much, guys, for your attention. I'll catch you in the next one.